Hello, Professor Gimetti again. We're going to finish up on lesson number 15. This is part 2. In this one, we're going to talk about cost volume profit, which is a relationship between the cost of what you're producing, the volume, the number of units that you're selling, and the profit that you make. Okay, so if we take the selling price of a unit and subtract out its variable cost, let's say that we have a selling price of $8 per unit of a good, and it's costing us in variable costs. Variable costs vary with the level of output. So for instance, if we are producing, let's say, $8, what can we sell for $8 these days? Let's say a glass, okay? We're selling a glass that we're selling for $8, and the materials in that glass and the labor involved in building that glass and all of the other variable costs of building that glass are $6 per unit. Then the contribution margin per unit is $2, which means that that's the portion that goes to pay off the fixed costs, and then once the fixed costs are paid off, we then put it to profit. Okay? Now, break even is nothing more than not having any profit or any loss. And to calculate the break even in units, we take the amount of fixed costs and divide it by the contribution margin. Okay? Or if you want the break even in dollars, you take the fixed cost and divide it by the contribution margin ratio. So in this case, the contribution margin ratio is 25%. Okay? Now, if we wanted to make a calculation, let's assume that we have a selling price of $8, variable cost of $6, contribution margin of 2, which we had up here, fixed cost of $10,000, and we wanted to earn a desired profit, DP. Okay? The calculation to come up with the number of units that we need to earn our desired profit is our desired profit plus our fixed costs divided by our contribution margin. So if we did that, we take our desired profit plus our fixed costs and divide by 2. That's 15,000 divided by 2 is 7,500 units, that we need to sell for $8 a unit to make sure that we have our profit. And if we do that, 7,500 times 8 is $60,000 in sales minus 45,000. How I got that was I took the 7,500 and multiplied it times 6. That's the variable cost per unit, to give me total variable cost of 45,000. If I subtract those out, I get a contribution margin of 15,000. Fixed costs were given as 10,000. We subtract that out, we have $5,000 of profit. It works out. It matches. Okay. Now the margin of safety is the current sales minus the break-even sales. So if I told you right now that our current sales were $70,000, okay, you could calculate the break-even point here, which would be your fixed costs of 10,000 divided by your contribution margin ratio, which is 0.25, which would give you $40,000. That's what it takes to simply break even. So right now, if we're selling $70,000, we have a $30,000 margin of safety, meaning that our sales could go down by $30,000 and we still would break even. Here, when we had sales of $60,000, our sales could go down by $20,000 and we would still break even. Okay. Now, the other item in this particular chapter, this lesson, is the degree of operating leverage. Now, the degree of operating leverage deals with how much you have in basically fixed costs. Okay? It is the sensitivity of operating income to changes in the level of output. And it is calculated by taking the percentage change in earnings before interest and taxes and the percentage change in unit sales. So if we have this scenario here, or if we have $1,000 in sales and come up with EBIT of 100 and our sales increased to 1,200 and we have EBIT of 150, then our degree of operating leverage would come out to be 2.5. 2.5 meaning that as our sales increase, our earnings before interest and taxes will increase at a higher multiple. Okay, that's what this degree of operating leverage means. Okay, and again, this concludes lesson 15. Thank you very much.